What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
All right, guys, Jay Martin here, CEO of Cambridge House, and now I'm joined by Justin Huhn, the founder of Uranium Insider. Justin, how are you?
Doing great. Yeah, thanks for having me.
I'm really happy to have you. No, I'm really glad to introduce you to our audience and pick your brain a little bit. I'm trying my best to understand the uranium sector, and so I'm binging on content right now, and I'd love to get your thoughts. So where I want to start, Justin, is for my retail audience, for myself, when it comes to the macro trends driving the surging bullish sentiment in uranium right now. What's the signal? Cutting through the noise, what are the key ingredients and indicators that you focus on?
Sure. Yeah, surging sentiment. That's a good way to put it. It's been quite the run for the past few months. It's an interesting sector in that positive fundamentals have been stacking up for years, and it's just taken this last signal, I guess you could call it, that started in beginning December to really get funds flowing into the space. The absolute bottom was last March with the COVID crash, and with Cameco shutting down Cigar Lake, and with Kazatomprom cutting off their well field development right about at the same time in March and then April, that kind of kickstarted the spot price, which brought some funds into the space. That ran for a few months. Cameco said they're bringing Cigar back online, and it went back down for a few more months. What happened in December was the Bear Traps report, Larry McDonald's largely institutional newsletter, put out a report on uranium on Friday, December 3rd. That went out in the morning, and we immediately saw massive volumes come into the space. Later that day, actually after hours, Zero Hedge picked up the same, picked up some pieces from that report, put out an article after hours. Okay. That went out to their 1 million plus subscribers. And over the weekend and the following week, we just saw it continue. And it's held, and it's continued since then with only a couple of weeks of mild pullbacks, mild consolidation. And what we've seen is a just huge amount of funds flowing into the space. So that's what we're watching right now, because the spot price is doing absolutely nothing at all. In fact, it's slowly trickling down, but it's happening on really, really small volume. So historically, what happens in the uranium market is investors watch the spot price. It's the most visible reported price on the fuel cycle. It's the price that investors watch. And so when we saw the market really starting to fly without the spot market moving, then we knew something was up. So digging into things since then, what we've started to see is some institutional investments, some hedge funds, some generalist funds come into the space in a pretty big way. Right. We're seeing people like Michael Burry. We're seeing people like Larry McDonald and some larger, well-respected hedge fund managers and newsletter writers speak positively about the investing case for uranium, especially as a part of an ESG investment, as capturing an energy trade as one way to play a broader commodities run with a cyclical move from out of growth and into value, et cetera. So we've seen almost $500 million come into just the URA and URNM ETFs in the past 12 months. And I would guess that probably 2/3 of that has happened in the past 90 days. Those are just the ETFs. And we've seen record volume come into the mid caps, come into the large caps, NextGen, Denison, Cameco. So what we're seeing essentially is a broad acceptance of nuclear and of nuclear energy on one side, and on uranium as an investment case as part of these commodities, ESG investing, kind of come together at the same time. That's kind of what we're seeing,
right?
In my opinion.
Now, what's behind that acceptance? Because is it just demand, Justin? Is it a change in perception? I mean, most of my life, nuclear energy has been stigmatized somewhat inappropriately. Right. Is the perception changing, or is it just demand fundamentals are too strong to ignore? What are your thoughts?
It's both. Perception is definitely shifting, even from just, I've been following this market for close to 5 years now, even 2-3 years ago. To expect to see what we're seeing now as far as sentiment around nuclear energy is pretty astounding. We never would have thought we would be seeing this. So we're seeing, the environmental left slowly start to embrace nuclear energy as clean energy and as an essential part of some sort of green energy future. In the States, the Biden administration is showing support for nuclear energy. We're seeing it across the globe. So that's part of it, and just this increasing acceptance of nuclear. And then you also have a glaring supply and demand deficit, a supply deficit, and a supply and demand disjunct in the uranium market that has been obvious for years. And I think uranium investors that have been aware of this for the last 2-3 years are kind of like, finally, finally, the market is waking up to this because it's been clear. We have right now, we've got about 180 million pounds of U3O8 equivalent demand globally annually. And last year we had about 125 million pounds of uranium produced. It's a huge supply deficit. And that doesn't include the secondary supply that comes in from tails re-enrichment, from underfeeding, some MOX fuel, some mixed oxide re-enrichment of tails, things like that. But it's still a huge supply deficit that doesn't really change until we have higher uranium prices to justify, firstly, bringing on the mines that are under care and maintenance, most notably, Cigar Lake right now, currently, that's down because of COVID. We expect that to come on this year, probably in the next few months. But McArthur River, which is 18 plus million pounds a year mine, owned by Cameco in Saskatchewan, that's been down since June of 2018. And Cameco stated they're not bringing that back until they have a sufficient order book in the 40s per pound, which they have not yet even begun to fill. We also have Paladin's Langer Heinrich mine in Namibia that they need about $55 a pound to justify that mine coming back online. And so with Cigar back, with McArthur back, with Paladin back, we start to approach, and we don't expect all of that to happen for a number of years at this point because it takes a long time, plus the uranium price justifying it in the first place and the capital needed to do the restart. We start to see a slowly balanced market, but it doesn't really matter because the way that utilities purchase when they come into the term contract market is they purchase out for 5 to 10 years at a time. So even with these care and maintenance mines coming back online, we still see an increasing deficit, let's say 2025 to 2030, that we need many more new mines. All of the mines that are planned and proposed, all of those need to come online in order to even approach filling that deficit by the end of the decade. Got
it. So if you're running Cameco today, are you looking for acquisition targets?
Not necessarily. I think that people have been screaming for Cameco to buy NextGen.
Yeah.
And I think that they had the opportunity last year and they didn't take it. So I don't necessarily see that happen right now. They still do have some JV exploration partners. They have a pretty long life mine with the JV with Kazatomprom at Inkai. And they have expansion potential for both Cigar and McArthur to produce more than what is currently stated in their mine plan. So I think that they still, even though the writing is on the wall that the market needs to go where it needs to go, I think that they want to see them start to fill up their order book for McArthur and see that come back online, or at least the plans for that to come back online in the market to support it before they go on an acquisition spree. They probably also want to see the funds from this CRA tax liability case come back to them and be literally in their hands before they spend the cash or the shares on an acquisition. But I could be wrong, but that's my take. Yeah.
Okay. Now, how much do you concern yourself with jurisdictional risk in the uranium sector, Justin? Is it a core focus for you? Is it in the periphery? Talk to me about that.
Yeah, I would say it's a pretty core focus. It's not necessarily number one focus criteria for us, but it's definitely something that matters. We don't like to invest in anything that is in a jurisdiction where it's possible that they just pull the plug on the company's primary projects. It's just not something we're willing to gamble on. Of course, those companies typically have much lower valuations, and if you take that risk and things work out, you can have a huge winner. Yeah. But it's just too risky for our liking. Yeah, we prefer the jurisdictions that have a history of supporting uranium mining.
Okay, so then do you think, is it important for the US to develop a domestic supply? And you can factor Canada into that domestic supply, but do you think that's a core focus for the United States?
Yes, I do. Yeah. The United States produces 20% of their electrical grid from nuclear, and they produce almost zero uranium. last year. It was what, a couple £100,000 or something last year. It was next to nothing. So I think, there's a lot of politics behind whether or not to support the uranium market, to support the uranium miners, to support conversion and potentially enrichment. But I do think that it is a national security issue to have 20% of the grid unsupported by the actual feedstock for that energy source. So I believe it's important for the US and Canada as well. Yeah.
Okay, got it. Now, if we are at the budding stages of a uranium bull market, sure looks like we could be, you know how this is going to play out, right? There's going to be all kinds of cowboys and promotes that enter the space. And so I want you to give my audience some help in avoiding landmines. Justin, what do you look out for? How do you do, what's the quick diligence you do to remove companies from the watch list?
That's a good question. So what do I do to remove companies? One of the first things I look at is share structure for an established company. If you're talking about new entrants, or you're talking about established companies?
New entrants.
New entrants. Okay. New entrants is all about the management team, because I feel that the bulk of the great projects are probably already owned by a publicly traded company that's already familiar by the market. Or to the market, I should say. So it's all about the management company. So we have a position in a company that we took last summer that on paper, their projects don't really look like anything fantastic at all. Now they're moving in a good direction. They've been acquiring projects that are looking better than what they started out with. But the share structure when the company reorganized was fantastic. The CEO is fantastic. The team backing him is great. And the company was dirt cheap. So it was a no-brainer investment for us.
And now I have to ask the name, Justin.
I can't do that. Because of my newsletter subscribers. It would be treasonous. I apologize. But I mean, there's only 55 companies in the space. So if you look at who went through a name change last summer, there's 3 options. You'll figure it out. Yeah. So yeah, it's all about, I would say, management and a relative valuation. So if a company's coming out and the valuation looks cheap and the management looks trustworthy based on their past performances, what have they done in the past? Have they done anything shady? What's their ownership? Are they buying into that initial funding personally from money out of their own pocket? That's always a good sign.
Yeah.
Have they acted respectfully towards shareholders of previous companies? That's kind of what I would look for in a new company.
Okay. And then, you asked me to differentiate. So what about existing companies?
Existing companies, I look at share structure pretty quickly. I prefer to not have billions of shares outstanding. I prefer to have a lower percentage of outstanding options and warrants as a percentage of total fully diluted shares. If you see a company with like 50% of their fully diluted is in options and warrants, it's a pretty big overhang. It shows that there's been pretty excessive options granting and excessive dilution in the past. So unless that went towards some really, really smart acquisitions and brought a lot of value to shareholders, it's something that's at least a little bit of a red flag. We look for, again, relative valuation. We're always trying to find hidden value. So, which is difficult to do in the uranium space because almost all of the companies are producing nothing. So how do you value a company that has and may never have cash flow? It's very difficult. You have to look at a bunch of different aspects. One of the things that we look at is like a very basic enterprise value to pounds in the ground. That's not a definitive thing to look at, but it's something it's at least some metric to make some kind of comparison to gauge rough valuation. And then insider ownership is huge. We love to see operators of the company that have been there for a while, that have done well in the past, and that own a big chunk of the current company. And if there's institutions that have been with the company, especially if there's institutions that own this company that have backed this team in a different project in the past, that's usually a really, really good sign because they're putting their money to back these people. And we always like to back people more than projects for the most part.
We're very aligned on that bullet point. Okay, awesome. Justin, what can people find at uraniuminsider.com?
At our website, there's some links to previous media that I've done. There's a free newsletter that We put out called the Market Update newsletter, and we put out an email every couple of weeks, just very basic email, just kind of keeping people updated on what's happening in the macro. And then we have a premium newsletter that's an annual membership, and that's we put out a monthly newsletter that's very, very in depth. That goes out at the beginning of the month, and then a few bulletins throughout the month as needed, as company updates for the companies that we follow. We have a focused list of companies, our investments we have 10 positions. We keep it to 10.
Okay.
That's what you get there. We've done pretty well. I think we're up about 285% since our inception, which is August 2019. And we're always trying to find hidden value for our members. It's been a good experience so far.
Okay, excellent. All right, look, thanks so much for coming on. It was great chatting with you and introducing you to our audience and picking your brain a little bit. Appreciate it.
Thanks a lot for having me, Jay. Really appreciate it. It's been a pleasure.